IND AS 37, lot of concept between IND AS 37 and AS 29 are same. So if you know and remember that properly, this is pretty straightforward. Okay. First, IND AS 37, sir, excludes few things. One is executory contract. If it is executory contract, you don't apply IND AS 37. But however, if it is onerous contract, you apply. For onerous contract, IND AS 37 is applicable. For executory contract, it is not applicable. So what does executory contract mean? Executory contract means the parties in the contract, none of them have fulfilled their obligation or they have performed their obligation to equal extent. They fulfilled their promises to equal extent or not, they have not performed their obligation at all. That is the thing. I used to give you, in fact, a joining bonus example. Let's say one company has got a job offer. One employee has got a job offer from Reliance. Okay. Reliance gave him a joining bonus of, or Reliance told him, we'll give you a joining bonus of 5 lakh rupees. They've just signed an agreement saying, employee said, we'll join you. They've signed the employment agreement, but the employment starts next month. They've just signed the employment contract, but the employment actually starts on next month. Now, this is an executory contract. How? Sir, both of them have signed the contract, right? So that means both the parties have fulfilled their obligation to equal extent. But what is Reliance's obligation? To pay joining bonus. Have they paid it? No. What is employee obligation? To join the company. When will that happen? Next month. So employee has not fulfilled his obligation, which is joining the company, which will happen next month. Reliance also has not fulfilled their obligation to pay joining bonus because employee has not yet joined. So this sort of contract, we call it as executory contract. If it is executory contract, don't apply IND AS 37. It is out of scope. Okay. Next. Sir, one of the primary thing for IND AS 37 is, IND AS 37 primarily deals with provision, contingent liability, contingent asset. Only these three things: provision, contingent liability, contingent assets. For you to book provision or disclose contingent liability, one of the key factors that you look for is obligation. Only if obligation is there, provision and contingent liability disclosure will come into picture. If obligation is not there, both of them are ruled out. So what is this obligation? They have not defined obligation, but they have defined obligating event. Obligating event is that event where the entity has no realistic alternative but to settle the obligation. Or in layman terms, we can simply call it as no escape. If the company has no escape scenario, we say company has obligation. If they cannot escape from it, like somebody has filed a case against me. Okay, let's assume. Sorry, you're teaching pathetically bad. Okay, your teaching is worst. Bolke, they filed a case against me. Okay, assumption. Don't do all this and all. Okay, just for the sake of example, I'm telling. Okay, now the case is going on in the court of law. Can I escape court ka proceedings? No, I have to follow the court rule. Whenever they call me for hearing, I have to go. Yes, no. I mean, is it escape scenario for me? No. I've got into what scenario? No escape scenario, because matter has left out of my hands now. Not only we call it as no escape. Okay. So if with no escape scenario, we say it's an obligation. So obligation could be of two types. One is legal obligation. Another one is constructive obligation. Legal obligations are those obligations which arises as part of contract or law. Now we have to pay gratuity. That is required as per law, right? Correct. So we generally, when you sell a product under a contract, you give warranties. That means warranty obligations arise as part of contract, like this. So those obligations which arise as part of contract or as per law, we call it as legal obligation. Those obligations which arises as part of previous trade practices or customs or published documents, that we call it as constructive obligation. Like, in fact, if you remember regular class, I used to give you the reward example. Let's say we ArivuPro, we have a practice of what, sir? Any student who gets a rank, we have a practice of giving him, let's say, 50,000 rupees. Any student who gets a rank, we give that student 50,000. We have not made any contract with any student. We have not written any email to any student saying we'll give you 50,000. Okay, nothing like that. But let's say you are studying with us now. You checked with your seniors. Okay, so do they pay this 50,000? Your senior told, yes, I had got a rank and I also got 50,000 rupees money from ArivuPro. That means what is in your mind, one idea is set now. What is that? If I also get a rank, I will also get 50,000 from ArivuPro. That idea is set in your mind now. That to be call it as constructive obligation. Because this is something which is arised as part of our previous trade practice of custom. Now we have a custom or we have a previous trade practice of paying the rank holders 50,000. Though we have not told our students or made any contract with them or signed any contract or sent any email saying we will pay 50,000, still our previous trade practice is such that an idea will be set, a valid expectation will be set in the minds of the users. So hence the company will still have an obligation and we will have to record that obligation in our books. So whether legally it will hold or not is a different issue. We are not bothered about that, but we need to account that. Such an obligation we call it as constructive obligation. Okay. All right, sir. So next is provision, right? I told you the standard only deals with three things: provision, contingent liability, contingent asset. Provision means provision is also a liability. Provision is also a liability, but with uncertain timing or amount, meaning when this liability will occur and how much this liability will occur, we don't know. Let's say you made provision for damages, right? How much you will pay, when you will pay, you can't say with certainty. You can only estimate. That's the difference between normal liability and provision. When you say normal liability, like creditor is a liability, right? How much you have to pay the creditor, when you have to pay the creditor is clearly known. But provision is also liability. But when it will come, how much it will come, you can't say, but only you can estimate. That's the meaning. Now the next question is, when will you recognize provision? Sir, you will recognize provision in your books when 4 conditions are satisfied. One, there should be a present obligation arising out of past event, which creates probable outflow of economic resources, and reliable estimate of the outflow can be made. The day all these are satisfied, all the 4 should be satisfied, that day you will go ahead and book the provision. What is that again? Present obligation arising out of past event. Let's take a small example. Sir, let's say A Limited has filed a legal case against B Limited. A Limited feels B Limited has stolen their patent. Patent infringement has happened. So A Limited has filed a legal case against B Limited, demanding a compensation of 10 lakh. Okay. Now we are thinking from B Limited perspective. Court case is already going in the court of law. B Limited asked their lawyers. Okay. Like this, some case is going on. What do you think? What are our chances? Lawyer told there is 70% chance that we will lose the case. There's 70% chance that we will lose the case. So that means we have to compensate A Limited. That's what the lawyer told. Now let's analyze this from provision ka definition or recognition criteria perspective. One is present obligation. We are analyzing from B Limited perspective now. Does B Limited have a present obligation? Yes. Obligation means no escape scenario. Is matter in B Limited ka hands now or it is left? It is left because the matter is decided by whom now? Court. Whatever court says B Limited has to do, correct? So the matter is not in B Limited ka hands now, it is left. So does B Limited have a present obligation? If court releases the order saying you have to pay the money today, B Limited has to pay. They cannot escape from it. So does B Limited have a present obligation? Yes. Arising out of past event. What is the past event here? Why has A Limited filed the case? Because A feels B Limited has stolen the patent, right? So the patent infringement or stealing of the patent happens to be your past event. Both are satisfied? Yeah. Third one is probable outflow of economic resources. Probable outflow of economic resources, what it means is, because of provision, there should be more than 50% chance of some resources going out. Resource means one asset going out. How will B Limited settle this? If court orders B to pay A, what will B Limited do? They'll pay cash, yes or no? Cash is an asset. That means due to this provision, an outflow will happen. An asset ka outflow will happen. And the chance of outflow should be greater than 50%. That's what we mean by the word probable. Probable means more than 50% chance. If there is more than 50% chance of some asset going out, okay, that is what third criteria of provision is trying to say. Now, in this particular example, what is a lawyer telling? There's 70% chance that we will lose the case. Is it more than 50%? Absolutely yes. That means, is it probable? Yes. If it is more than 50%, we call it as probable. So here is the obligation probable? Yes. Last one is reliable estimate of the outflow can be made. How much you will settle this provision, you should be able to reliably estimate. Like let's say a lawyer told, though A has demanded compensation of 10 lakh, we can settle it for let's say 6 lakh rupees. Lawyer told we can settle for, most probably the court will order us to pay 6 lakh rupees. That means you will make the provision not for 10 lakh, but best estimated amount of 6 lakh rupees. That is the case. So if all of them are satisfied, then you will recognize a provision. Present obligation arising out of past event, probable outflow of economic resources. Do remember the word probable. Probable means more than 50% chance of the outflow. If outflow ka chance is more than 50% and you can reliably estimate the outflow, if all are satisfied, recognize provision. Like that. Okay. Yes, sir. Next one is what, sir? Contingent liability. So contingent liability is chotta brother of provision. Meaning, sir, for it to be provision, the obligation ka chance should be more than 50%. However, if it's a possible obligation, then you will disclose, not account. Contingent liability are not accounted. So in business combination, we accounted. That is a recognition exemption. Don't bring it in everywhere. Only in business combination, subsidiary company ka in contingent liability, we record. Good that you know it, but don't bring it everywhere. That is IND AS 103 ka recognition exemption, not everywhere. But normal contingent liability is not accounted, but only disclosed. And if it is possible obligation, we disclose contingent liability. So what is possible obligation? Possible obligation means less than or equal to 50%. If it is more than 50%, we recognize provision. If it is less than 50%, we disclose contingent liability. There's one more which I'll fine tune this. For now, you can remember like this. Okay. So if it's a possible obligation, means if there is less than 50% chance of outflow, then we disclose contingent liability. Okay, sir. This is in layman terms. If you want to know the actual definition, contingent liability is a possible obligation arising out of past event. Same definition. possible obligation arising out of past event. The occurrence or the existence of this is confirmed by occurrence or non-occurrence of an uncertain future event not within entity's control. This is the actual definition of contingent liability. In case study comes, if you remember and write, it will be good. In case if you don't remember, I have told you how to remember them. Yes. Possible obligation. If outflow ka chance is less than 50%, you can write the first thing only. Instead of present obligation, write possible obligation arising out of past event. Okay, like that. Then you can construct something in your own words like this. Okay, less than 50% chance, we account contingent liability. But the definition is this: present obligation arising up, or rather possible obligation arising out of past event. The existence of this is confirmed by occurrence or non-recurrence of an uncertain future event not within entity's control. What does that third component says is whether we'll pay this obligation or not, who will decide? Like in this example, whether B Limited will pay this or not, who will decide? Court order. Is court order. That is the uncertain future event which the definition is referring to. Okay. And is the court order in A Limited ka or B Limited ka hands? No. It's a judicial system of a country. It cannot be bought or it is not under anyone's influence. Yes, no. That's what we say. That uncertain future event not within any entity's control. That future event is not within entity's control. That's the definition. Okay. Or present obligation. Present probable obligation not recognized as provision. Sir, if it's probable obligation means you should recognize provision. No. If it's a it's a probable obligation only, but we still disclose it as contingent liability. Sir, why, sir? So let's modify this example. So lawyer told we will lose the case. There is 90% chance that we will lose the case. Sir, if there is 90% chance means it is probable. But lawyer also told since it's our first time offense, there will be no outflow. The judge will say we will lose the case, but judge will say first time offense, maafi. You don't have to pay any penalty. Like that, judge will release the order is what the lawyer telling. So there is 90% chance of losing the case. So it is probable only. But is there any outflow? No outflow. So for you to recognize provision, there has to be an outflow. If there is no outflow, though it is probable, we still, in this case, we disclose it as contingent liability only. So provision ka third criteria, if it fails, it's probable, but there is no outflow of economic resources. In that case, we'll disclose it as contingent liability. Or outflow is there, but how much outflow you cannot reliably estimate. The provision for fourth criteria is you should be able to reliably estimate the outflow. If you can't reliably estimate the outflow, then don't book provision, show it as contingent liability. That is rare, but sometimes it could happen because we have seen, no. Let's say somebody filed a case against one company saying they've contaminated the land 15 years back. Somebody has filed a case against the company saying they've contaminated a land 15 years or 20 years back. Now you tell me, will that particular company have 15 or 20 years ka record to check whether we have done contamination or not? Lack of information, difficult to identify. Yes, no. Now it's digital age, so everything has a footprint. 15, 20 years ago, nobody used to store that much of data also. Yes, no. So if you don't have data means how will you estimate? Like that. So in rare cases, if you're not able to estimate the outflow, then provision need not be accounted. You can disclose it as contingent liability. That's what I've called out over here. Okay, sir. So do remember contingent liability is only disclosed. Okay. Another one is entity is jointly severally liable means other party ka obligation you disclose it as contingent liability. What is this? I've given a small example. Let's say A Limited is a manufacturer of raw material. And this raw material they exclusively supply to B Limited. Using this raw material, B Limited will manufacture a finished goods. It's a cosmetic product. Okay. And after manufacturing, they will sell it to the customer. Okay. Customer nicely put the cream on his face. You know, next what happened? Yeah, full bubble. Okay, face become like red full apple. Okay, Kashmiri apple like that. His face has become some adverse reaction has happened. So customer, sir, he became full happy and he filed a case against you. Okay, full furious mein he filed a case against you demanding a compensation of 10 lakh. This is what has happened. Now, sir, A and B have an agreement. What the agreement they have? Saying if anyone files a case, then we will bear the loss equally. Because sir, B has manufactured the product using A raw material only. No, I mean both are at fault. Maybe we don't know. That's the reason A and B have an agreement saying they will settle the obligation equally. Okay. Now we are talking from B Limited perspective. What is B ka share? First of all, how much is the demand? 10 lakh. Will B Limited pay entire 10 lakh or A and B will share? A and B will share. So what is B ka share? 50%, which is 5 lakh. So if the obligation is probable, let's say B Limited feels it is a probable obligation. That means they will book provision for 5 lakh. But we are not talking from this. What about A Limited? A Limited has to pay how much? 5 lakh. Sir, what if A Limited does not pay? Then B Limited has to compensate. Yes or no? So A limited ka obligation of 5 lakh. Sir, B will show it as, disclose it as contingent liability. Because if A defaults, then B has to pay that extra 5 lakh. Correct? Whether A will default or not, that is dependent on A ka performance in future. So we don't know. Yes, sir. So hence B will show his share. B ka share, he will show it as provision. Entity will show it as provision. But other party ka share, in just this case is A limited ka share, which is 5 lakh, will be disclosed by B limited as a contingent liability. That's what we mean by this particular provision. Okay, sir. Contingent asset is ulta. There, what did you write? Possible obligation. Here it will be a possible asset, because correct. No, it's for when it's a liability, there will be an outflow. But when it's an asset, there will not be an outflow. There will be an inflow. So here the definition, it's a possible asset arising out of past event. The existence of this is confirmed by occurrence or non-occurrence of an uncertain future event not within entity's control. So if you know contingent liability ka definition, automatically you can construct this also. Okay. And same like contingent liability, contingent assets are not recorded but only disclosed. And don't be misled by the word. Here actually I've written probable. Standard uses the term. If you look at the actual definition, they say it's possible asset. But I've written possible asset over here. Reason is you should not get confused. That's the reason. Standard uses the word possible asset. But this is the English word possible. You will recognize as per IND AS 37 and as per AS 29. It's the same. You will recognize or you will disclose contingent asset provided inflow ka chance is probable. Only if you have more than 50% chance that you will receive the inflow, then only you will disclose it as contingent liability. So that's the reason in the chart book I've not used the word possible, I've used the word probable. But definition uses the word possible. So this is an English definition. This is not percentage definition. Possible means may receive, may not receive. In that sense, they've used that word. Okay. So do remember, you will disclose contingent liability only if inflow ka chance is more than 50%. Like that. Okay. Now I've just summarized this particular table for you, which gives you an idea as to what you need to create on the asset side, liability side. Sir, if it is virtually certain means more than 95% chance. On the asset side, you'll book an asset. On the liability side, you can book a liability or provision. Study material uses the word liability and provision interchangeably because provision is also a liability. So instead of provision, you can also write liability. If it's virtually certain, meaning more than 95% chance, on the asset side, book asset. Liability side, you can book a liability or provision. However, if it's a probable means more than 50% chance, or 51 to 95% if you have to be more precise. Okay. So if it's probable obligation, so on the asset side, no, sir, you disclose contingent asset. On the asset side, you don't account anything. You only disclose in notes to accounts contingent asset. On the liability side, you will make a provision if it's probable. However, if it's a possible means 5 to 50%. Possible means 5 to 50%. On the asset side, you don't do anything. Just ignore. No contingent asset disclosure, nothing. On the liability side, you disclose contingent liability if it's a possible obligation. However, if the obligation is remote, remote means less than 5%. If it's less than 5% chance of inflow or outflow, we call it as remote. If it's remote, on both the side, you can ignore. You don't have to do anything. This quick table summarizes everything what you need to do on the asset side and as well as the liability side. And provision is recognized at best estimated amount, and management does this. Okay. Then present value. Sir, if the provision, if you are expected to settle after 1 year, generally if you're making a payment beyond 1 year, we say time value of effect of money is material. So you have to record the provision at present value. The perfect example for this will be a provision for DSR, right? Because you bought the asset now, but DSR cost maybe will come only after 5 years. Correct? Or 5 years, 10 years, we don't know, right? So current year we make provision for DSR. A provision for DSR is not accounted at future cost. We record it at present value. Why? Time value of money ka effect is material. That's the reason. So if any provision, if you are expecting to settle beyond 1 year, then record it now, not at the future value, not at the full value, but at the present value. Like that. And some risk adjustment also you can do in provision. Since provision is an estimate, you can go wrong with your estimates. So if in the problem, if they say there is a risk adjustment, then you can do that. Let's say you got a final amount of provision of 10 lakh. Then they say there is a risk adjustment of 5%. You can add 5% to the final amount. Or how do you find out provision? If you're, let's say, finding out the present value, if the provision is settled beyond 1 year, you have to find out present value. How do you find out present value? Take the future cash flows, multiply discount factor, then you will get present value of cash flows, right? You can adjust the discount factor here. In the future cash flows only, you can adjust, you can give the risk adjustment factor. Now, what is the risk adjustment factor? Sir, you thought the outflow is 10 lakh, but you also feel there is a 5% chance that it could be more than 10 lakh. You're thinking the outflow is 10 lakh, but you also you're doing a risk assessment and saying it could be 5% more than 10 lakh. That means you can add 5% to this directly. Whatever cash flow you're estimating, directly to that you can add. Or you can do the risk adjustment and discount factor. Let's say discount factor is 10%. You feel as per the risk adjustment, it should be 12%. So give the risk adjustment factor and discount factor calculation. That also can be done. Or you can do the risk adjustment in present value of cash flows. Take the final number. To that, you can give the risk adjustment factor also. So among any three, you can do the risk adjustment. That is what is called out over here. Okay. Okay. Next one is reimbursement. Reimbursement means what, sir? Name itself is saying reimbursement. So I mean, when you pay something, you will get back something. So reimbursement, sir, will be, you should record it as a separate asset. Now, what is this reimbursement? Let's say LG, and there is a dealer and there is customer. Okay, sir, LG has an exclusive dealer. Let's say LG has an exclusive dealer. Okay, let's say this is X Limited, and this exclusive dealer sells the LG product to the customer. Okay, well, let's say LG gives a warranty of 1 year. Now, customer has come back to X Limited. Let's say this is LG TV. Okay, we have sold some LG TV to the customer. I think TV is not popular. I think now it's the fridge that goes in LG, right? TV, we are preferring something else only these days. Yeah. Okay. So X Limited, let's say, has sold LG ka fridge to the customer. The fridge, let's say, stopped working, and customer went back to X Limited and said, you repair the product. It is not doing good. So now what X has done is he has paid, or he repaired, or 1 minute. Okay, let me see. Let's say X Limited feels in these sort of contracts, since there is an exclusive dealer, what is the arrangement between LG and X Limited is, whenever like these sort of things happens, X only will repair the product. He'll not come back to LG Limited. Okay. As per their exclusive dealing arrangement, what is the arrangement between LG and X Limited is, whenever this products, if there is any faulty products comes through, X only has to replace the product or repair the product. Let's say X feels he has to incur about, let's say 10,000 rupees to repair the product or replace the product or whatever, or replace a part or whatever. Okay. That means X Limited has to make a provision for 10 lakh because there is an outflow. Now, there is also another arrangement between LG and X Limited saying, if X Limited incurs any repairs cost, 80% of that LG will reimburse to X later on. First, X will incur, and later he will get the reimbursement from LG to the extent of 80%. Why? Obviously, sir, when X is selling the goods to the customer, he will not sell it at cost price. No, there will be some margin also. So LG is saying, I will not reimburse the margin. Let's say X ka margin is 20%. So LG is saying, I'll reimburse 80% of this. Okay. So now you're talking about X Limited ka perspective. X has an obligation to pay to the customer here. Yes, they have an obligation to repair the product, and repair cost is estimated to be 10,000. So X Limited has to record a provision for 10,000 in his books. But at the same time, X Limited also has a right to receive money from LG, because the moment he incurs repairs cost, he has an obligation to get this money reimbursement. That means he will book something called reimbursement asset. In this case, example what? 10,000 k 80%, which is 8,000. That we are referring to here as reimbursement. So if a company is getting reimbursement, they should show reimbursement as a separate asset, provided it is virtually certain. Virtually certain means more than 50%, 95% chance. If X Limited feels there is more than 95% chance that we will recover money from LG, then they will show reimbursement as a separate asset. This provision will be shown separately in balance sheet, and reimbursement will be shown separately in balance sheet. It will not be netted off. In P&L, if you want, you can net off. Because what is the journal entry for provision? Journal entry for provision is SPL account debit to provision 10,000, 10,000. What is the journal entry for reimbursement asset? Reimbursement asset account debit to SPL account or P&L account 8,000, 8,000. So in P&L, if you want, you can net off, but in balance sheet, these two components should be shown separately. That is what I've called out over here. Okay. All right. Changes in provision. So provision is an estimate. Estimate is based on certain facts and conditions and circumstance. If those circumstance changes means, you can revise the provision. You can increase the provision. You can decrease the provision. You can reverse the provision. From provision, it may become contingent liability, or from contingent liability, it may become provision. All permutation combinations are acceptable, and accordingly, you can change your accounting entries. The amount of provision basically can be changed. That's what I'm calling it out here. Provision, we don't make it for future operating losses, because one of the definition of provision is present obligation arising out of past event. We make provision for past event, not for future operating losses. So in future, if an entity feels they incur any loss, you can't make the provision for it now only, because provision is not a future driven activity. It's based on the past event. That's the reason. Okay. Then it is onerous contract. Onerous contract means what, sir? Onerous contract basically is a loss-making contract. We saw initially only. For executory contract, IND AS 37 is not applicable. But for onerous contract, it is applicable. Onerous contract, basically we call it as loss-making contracts. Or all loss-making contract, we call it as onerous contract. Like let's say, here A Limited, sir, has made a contract with B Limited to purchase the goods. Not now. They'll purchase it for, let's say, 10 lakh rupees after 3 months. A Limited feels the price of the product will increase, so they made the contract now only, saying they'll purchase it after 3 months by paying 10 lakh rupees. A and B both have made the contract like this. After this contract made, let's say after 1 month, the economic conditions have become very bad. Because what will A Limited do after purchasing? After purchasing the product, let's say A Limited is a dealer. Okay, he's a wholesaler or a retailer. So after purchasing, what they'll do? They will sell. But economic conditions after 1 month of this contract, sir, has become very bad. So A Limited feels after purchasing this product, he will sell. A Limited feels he can sell this product maximum for expected sale value is 7 lakh rupees. A Limited feels the worth of this product that he can sell it for is only 7 lakh rupees. But A Limited has already made a contract and it's a binding contract. You cannot escape. And this contract has, let's say, exit penalty. If A Limited backs out, if they don't purchase this product after 3 months, there is an exit penalty of 1 lakh. A Limited has to pay B Limited exit penalty of 1 lakh if A Limited cancels the contract. Now you check, sir, what is the nature of this contract? Is it a profit making contract or on all angles it's a loss? On all angles it looks like a loss. Yes, no? Because if you cancel the contract, you have to pay a penalty of 1 lakh. So that is your loss. If you execute the contract, if you go ahead with the contract, you should purchase it for 10 lakh. After purchasing, you will sell it only for 7 lakh. That means you will make, so what, sir? If you execute the contract, you feel you will make a loss of 3 lakhs because you will buy it for 10 lakh and you will sell it only for 7 lakh. So you will make a loss of 3 lakh. But if you cancel the contract, you will have to pay a penalty of 1 lakh. That means on every angle it is a loss. So such contract we call it as onerous contract. If you have onerous contract, you need to make the provision. Now you think, if you are a finance manager of this company, what will you do? Obviously, you look for that option which gives you a lower loss, correct? If you execute, 3 lakh loss. If you cancel, 1 lakh loss. Which is better? Cancellation. That's what IND AS 137 also says. You make the provision for lower of the above two amount. You make the provision for lower of the above two. In my case, lower of the amount is 1 lakh. So you will make the provision only for 1 lakh. This they are trying, I gave it in words. They are trying to express in words. Can we look at that? So for onerous contract, you make the provision at lower of the two amounts. One is the exit penalty or excess cost of servicing the contract over future expected benefits from the contract. Excess cost of servicing the contract over future expected benefits from the contract. Excess cost. So what is the cost basically? Excess cost of servicing the contract means what is the cost of servicing the contract? If you execute the contract, what will be the cost? 10 lakh. Over benefits. Benefit means when you sell the product, you will receive money. No, that is benefit. So benefit is 7 lakh. Cost is 10 lakh. So what is excess cost? When compared to benefit, what is here? Cost is only more. No. So what is that excess cost? 3 lakh. That's what. Same words. So 1 lakh or 3 lakh, whichever is lower, you will make the benefit, will make the provision for, which is this. Okay, if you can remember the exact words, it's okay. Or simply you write, if you don't remember, provision is made lower of exit penalty or excess cost. Whichever is lower, accordingly, you'll make the provision. Like that you write. Disclosure is not really that important over here. One disclosure is contingent asset, contingent liability, reimbursement, restructuring. All this if you have, give a separate disclosure. Okay. Then the last aspect is restructuring. So restructuring means closing down a division, changing the management structure, etc., etc. All this we call it as restructuring. So should we make any provision for restructuring? Yes. For committed cost of restructuring, you should make restructuring provision. So when can you say organization has got committed to restructuring? One, a detailed formal plan should be made. Because if you're planning, let's say you're planning to close down a division, right? So this is not a small exercise, right? You left, right, just like that, you can't take a random decision of closure. It requires a careful plan. Right? Which division to close? What should we do for that division assets? What should we do about the employees working in that division? Okay, like this, that division could have hundreds of credit hours, etc., etc. Yes. So you should make a detailed formal plan, and that plan should identify which business is getting affected. Which business are you planning to discontinue? Which location is getting affected? If you have multiple locations, let's say Bengaluru, Chennai, Hyderabad, Delhi, like this, restructuring is affecting which location? Which all employees are getting affected, or which all employees will get compensated? What is the total restructuring cost that you will incur, and what is the tentative date? When will the plan be implemented? All this should be called out in your detailed formal plan. Make the plan. This plan not only should be made, it should be implemented or communicated. Only when you should make the plan, and either you should implement the plan or communicate the plan. Make this plan and communicate to the respective parties. Let's say if you feel employees, a lot of employees, if you're going to fire, intimate the employees saying that we might fire you. That is one. So communicate the plan or implement the plan. Start firing few people. You announce that a few division ka employees you start firing. That way, all the division ka employees will get a fair idea that we might be fired, like that. So either you should implement the plan or communicate the plan. When you do this, valid expectation will be set among the users. Okay. So the day these two criteria get satisfied, we say organization has got committed to its restructuring activity, and for such committed restructuring cost, you can make the provision. Okay. But do remember, don't make the provision for your relocation cost, reorganization cost, future investment plans, etc., etc. Like, to give you an example, I've written it over here. Let's say I am planning to shut down CA practice. Initially, that's what I did. I was never meant to be a CA teacher. Yes, I started my practice. My practice did not click at all, and I lost patience. So I came on to the teaching, so that what type do they say? No, yeah, I had to even fill my tummy and all that, right? So because I had a shortage of funds, I came into the teaching arena. Now probably God's grace, things are doing good. Hopefully it stays that way. Thank you all for that. Thank you. I think I have not said this enough. I'm here because of the support and the love that you have shown, the lovely people. So thank you so much. I know that I say this often, but it is a deep statement that I personally kind of feel this on a day-to-day basis. So thank you all for showering that amazing support and love, and hopefully that continues as well. And I also try my best to give my best possible service that I can from my end. Okay. Yeah, let's continue with this. Yeah. So let's say I'm planning to close CA practice and start CA coaching. Okay. Now, if I'm planning to close CA practice means I will have probably some employees. Those employees I'll have to let go. And if I have planning to let go of employees means I can't send them empty-handed. I have to pay them some money and then I have to fire them. So that is committed cost associated with restructuring. For that, you can make provision. But now, sir, after closing CA practice, what am I planning to do? Start CA coaching. Sir, if I have to start CA coaching, let's say for CA practice, no, sir, I had bought a normal laptop. Normal laptop was good enough for me because we use only few softwares. We don't use high-end softwares. Okay. So normal laptop I had bought, budgeted laptop I had purchased. But for CA coaching, no, sir, budget laptops will not work. Your capacities, it should be i7 plus. Okay, RAM, all. In fact, whenever we're doing any coaching business, any recording you see, no, you should always have gaming laptop. Lesser than that, the processor will break down. Okay, you'll not be able to conduct class at all. So that means you need a little sophisticated laptops for conducting the class, because we conduct the class for 5 hours, 6 hours and all. No, the system should support for that. Many softwares we require. So that means for starting CA coaching, I need to buy a sophisticated laptop, iPad, so camera and all that. So I'll buy this in future. Can I make provision for that now only? No. I can't make. Why? Sir, provision should be made for past event. You are closing a CA practice due to an event. That is a past event. Now this, whatever new laptop and all, whatever I'm buying, it's for the new business. It is not associated with past event. It is related to the future event. So for that future investment and all, don't make the provision now only. Okay. So if you're planning to buy any future assets, or let's say I'm planning to relocate. Initially I was doing practice. Okay. Let's say I was doing practice in one remote area. Okay, where there was not much internet connection and I didn't require those. All right. Now, when I'm planning to start CA coaching, right, I have to do online coaching means I should have a good internet connection. So I'm planning to relocate to Bangalore. So I incur some relocation cost. Can I make provision for relocation or reorganization cost? No, because it is not related to my existing business. It is related to me something new things. So it is a future event. It is not a past event. So hence, for your future investment, relocation cost, reorganization cost, do not make the provision because it is not a past event. It's not related to a past event. Rather, it relates to a future event. That is the reason. All right. So this is about the provision. Okay. Thank you. Thank you for your wonderful comments, Yamini. Thank you. All right. So I'll continue with a few questions now. Question number 28. XYZ enter into a contract to supply 100 televisions for 2 million. Okay, we have entered into a contract. We made a contract to sell televisions for 2 million, that is 20 lakh. An increase in the cost of input has resulted in increase in the cost of sales to 25 lakhs. So cost of sale is your purchase cost. So due to some input increase cost, they are saying my cost of the TV from 20 has become 25 lakhs. Sir, I've entered a contract. I've not executed a contract fully. Okay, I've made a contract that I will sell the TVs for 20 lakh rupees. But later on, due to some changes in the economy, the cost of the TV has become 25 lakh. Not me, they are telling. Yes, no. All right. The penalty for non-performance of the contract is 0.25 million, which is what, sir? 1 million is 10 lakhs. So this is 2,50,000. Okay, correct? Or maybe let's keep it in million only. It's better. So if you execute the contract, you will suffer a loss. I'll keep it at this level only, better. Sir, you will sell it for 2 million, but your purchase cost is 2.5 million. So if you execute the contract, you will incur a loss of 500,000. Correct? No? Because your purchase cost is 2.5, you will sell it for 2 million. So if you execute the contract, you will make 0.5 million loss. But if you cancel the contract, you have to pay an exit penalty of 0.25 million. So this contract only, what do we call this as? These contracts, we call it as onerous contract. And for onerous contract, should we make provision? Yes. At what? Lower of two amounts. Which is the lower of two amounts here? 0.25. So in this case, we have to make a provision for 0.25 million as it is onerous contract. Right, onerous contract definition, facts of the case, and finally conclude that we need to make a provision of this much. Okay. All right. Next to 29th. A Limited completed the construction of power generating facility. Construction cost is 2 crore rupees. So their construct power generating facility means this is a PPE that they're talking about. So construction got completed on 1st October. Total construction cost is 2 crore. The factory was capable of being used from 1st October, but A did not bring the factory to use until 1st January. That is their headache. We charge depreciation from the day it is available for use. This is put to use. That is relevant for income tax. We don't worry about put to use in accounts. So 1st January is irrelevant for us. Useful life of the factory was 40 years. Legally, there was no requirement to restore the land on which power generating facilities stand to its original state at the end of the useful life. But A Limited has a reputation for conducting the business in an environmental friendly way and has previously chosen to restore similar land even in the absence of legal requirement. Okay. Sir, we are constructing power generating facility in one land. Due to this facility construction, land is getting damaged. Legally, as per the law, we don't have any obligation to restore the land. But we operate in an environmentally friendly way. That is our practice. Previous practice is like that. Even though law doesn't say us to restore the land, we will still do it. That means indirectly, what are they saying? Here CO exists. CO as in constructive obligation exists over here. Obligation need not be legal alone. It could be constructive obligation also. So your constructive obligation is there. So will you make a provision now? Yes, probably. We'll see. The directors estimated that the cost of restoring the land in 40 years time would be 1 crore. This is a future value. Will we make the provision for DSR at future value? No, we have to use present value. They use discount factor is 5%. At 5% at 40 years time, they're saying PVIF is 0.142. So multiply 1 crore ka 0.142. I think I've already multiplied. Where is it? Provision for DSR, you will make it at 14,20,000. This is one. Okay. So will you record this? Yeah, this is a DSR cost. Will you add it? Will you transfer it to P&L? No, you will add it to the cost of PP. So the journal entry for what, sir? This is a DSR. PP account debit to provision for DSR, 14,20,000 you'll add. Okay. So since that means what is the cost of the asset? Cost of the asset is not 2 crore, it is 2 crore, 14,20,000. Yes, no? Fine. That means you have to depreciate the asset because it is available from what date? It was available from 1st October and year is ending on 31st March. So that means you have to depreciate this asset for 6 months. Life is 40 years, but current year you will only charge 6 months depreciation, which is this much. After depreciating, this is the cost of the asset. On provision, what do you have to do? Provision you'll have to do. Sir, you have recorded the provision at present value, but settlement will happen in future. That means you have to do that unwinding of interest wala accounting. ACM table you need to put up. That is what directly I put up here. So visualize in ACM table what you will do. Provision opening balance is 14,20,000. Then you will add finance charges. Finance charges at what rate? 5%. So 14,20,000 ka 5%. But 5% is for the whole year. In the current year, you created provision only on 1st October and year is ending on March. So you will record finance charges not for the whole year, you're only for 6 months. Because provision came only on 1st October. That's the reason. So into 5% into 6 by 12 you do. So this is your finance charges. The entry is finance charges account debit to provision for DSR. Same like your ACM table accounting. Then have you paid anything? No, you will pay at the end. So provision for DSR to bank will not come now because payment will happen after 40 years. Okay. And this finance charges will be transferred off to P&L and depreciation also you need to charge. The entry for depre is depre to PP. So that means what will be the value of provision? I think they've asked you the extract over here. Balance sheet and P&L extract. So what will the balance of provision, what amount of provision will come in balance sheet? Add these two basically. So provision balance will become how much? I think I've told that here. Here 14,20,000. To that you add finance charges. Closing balance of provision will become 14,55,500. In an SPL, depreciation will be accounted. Finance charges will be accounted. That is your extract. Okay. Just say if they ask accounting treatment, pass the journal entry. If they ask you to analyze, you can express it in words. So take a call based on what they've told in exam. What they've asked in the examination question. Okay. All right. Question number 30. U Limited is a large conglomerate with a number of subsidiaries. It prepared CFS on 31st March 2018 as per the notified IND AS. Financial statements are due to be authorized for issue on 15th May. It is seeking some of your advice, they're saying. G Limited is a wholly owned subsidiary of U Limited, engaged in the management consultancy service. Okay. On 31st January, Board of Directors decided to discontinue the business of G Limited from 30th April 2018. So they decided one of the subsidiaries operation they will discontinue. Okay, they made the plan to discontinue on 31st January, but it will be discontinued only from 30th April. That means only on 30th April you can treat this as a discontinued operation. Okay, the day the revenue generating activities get stopped, that day it becomes a discontinued operation. On 31st January, you simply made a plan, right? It is not discontinued. The actual discontinuation happened on 30th April. So from 30th April onwards, this G Limited operation, you will treat it as discontinued operation and apply IND AS 105 provision. Okay. G Limited does not have many assets or liabilities. It is estimated that the outstanding trade receivable and payable will be settled by May. Okay. All that is goalie. That's fine. But they've offered employees of G Limited some termination payment. G Limited has some employees for which we are giving some severance pay or termination payments. On the date of public announcement, it is estimated that it would have to pay 540 lakhs termination payments to employees. Okay. The cost of relocation of employees who would remain with the company is 60 lakhs. So relocation cost will we make provision? No. Actual termination payment total 520 lakh made in full on 15th May. Sir, this is IND AS 37 and IND AS 10 combination question. Okay. So you made this restructuring, you know, right? The condition was existing on 31st January. On 31st January only, that the parent had decided that subsidiary cooperation we shall discontinue. So the facts existed on the balance sheet date. Further evidence came later on. So that means this is an adjusting event. So you have to apply IND AS 10 provision. So it becomes adjusting event. So on 31st March, you expected the payment, termination payment to be 540 lakhs. But finally the payment came to only 520 lakhs. Since the condition was existing on the balance sheet date, no sir, it's an adjusting event. Okay, because here your financial statements are getting approved on 15th May. Before approval only, you got to know the final payment amount, which is what? 520 lakh. So you will make the provision only for 520 lakhs. So here, IND AS 37 and IND AS 10, both are getting triggered over here, along with little bit of sprinkling of IND AS 105 discontinuing operation. So 3 standards combination question this is. Okay. As per the estimates made on 15 May, total relocation cost is 63 lakh. We don't have to worry about relocation cost because we don't make provision for it in the first place. Okay. G Limited had taken an operating lease which is expiring on 31st March 2022, little later. The present value of future lease rental is 430 lakhs. On 15th May, G Limited made a payment of 4 lakh 10 rupees in return for termination of lease. This is an onerous contract. Why, sir? Sir, if you continue the lease, totally you have to pay 430 lakhs. If you cancel the lease, you have to terminate by paying 10 lakhs. So it's either way, it's a loss. Okay, so it's onerous contract. You make the provision for lower of the two amount. Which is the lower of the two amount? 410 lakh rupees. So that means you have to make one provision for termination penalty, which is 520 lakhs. Another for onerous contract, which is 410 lakhs. So total provision, you will make it for 930 lakhs. That is what I've written over here. And you also need to write IND AS 105 provision. The operations of G Limited will be discontinued from 30th April. So current year is ending on 31st March 2018. The current year, it is not a discontinued operation because you're planning to discontinue only on 30th April. Next year. Okay. So next year it will be considered as discontinued operation, not current year. Why, sir? Matlab, what is the implication of that, sir? Sir, if it is discontinued operation, as per IND AS 105, what it says? You don't have to show income expense of discontinued operation. You just need to show profit before tax of discontinued operation, tax expense of discontinued operation, and profit after tax of discontinued operation. That you will not do it in the current year because in the current year it is not discontinued operation. That is one you will write. And then you will write, and is there anything else? The loss after tax for G Limited is 400 lakh. G Limited is expecting that in future operating loss, they'll make 60 lakh. Will you make any operation for future operating loss? No. Then you will write, as per IND AS 37, we don't make provision for relocation cost as well as for future operating loss. Write that. That's all. Okay, take a call based on marks. If it comes for around 6 to 8 marks, you need to write a little extra provision. Okay, sir. Yes, sir. So with this, IND AS 37 also we have finally completed, sir. Thank you.